John Manley joins us now. He's chief equity strategist at Wells Fargo Funds. John, great to have you with us today. You know, it is exciting to have these historic highs and these milestones, but how should Americans feel about all of this? You know, Dow 17,000, strong jobs number, but the economic number, the economic growth, GDP, on the downside. So, you know, connect the dots for us. How healthy is the economy and the stock market?
Well, every now and then you have to ignore a few dots that I think are sort of out of place. I think things are going from okay to good, and I think that's good for the stock market. I think that the Fed is going to be slow to raise rates because they want to make sure, very sure it's okay before they do. And meanwhile, earnings are accelerating. So I think earnings go up before interest rates, and that's good for stocks.
Stocks, though, John, are supposed to zig and zag. They go up and they go down. They've been going up for 2.5 years. We haven't had an appreciable decline of 10%, the proverbial correction in this market, for a while. Are we setting ourselves up as we go higher for even more pain when the correction finally does come, do you think?
You know, someday it's going to come. I guarantee you I will not sell at the top, but I think I'll sell within 5 or 6% of the top. We've had a pretty good number of 5 to 10% corrections, let's say 5 to 7% corrections. That took the steam off, and as your report said earlier, people are still skeptical. It's that skepticism that has to be maintained rather than a round number like a 10%er.
You know, starting next week, you mentioned earnings a moment ago. Starting next week, we're going to start hearing from companies with their corporate reports for the second quarter. Do you think that what we hear from CEOs and we look at the numbers and the guidance looking forward are going to take stocks higher or lower?
Higher. If I had to pick one, it'd be higher. I think the number's going to be pretty good. You never know exactly what's going to come until it comes. But the last week of the quarter is usually the confessional period when you get the bad numbers, if they're going to be there. We didn't see that many, and I get the sense that earnings are beginning to lift off rather than settle back.
JP Morgan today, with that strong jobs report, moved up the timetable when it thinks the Fed will begin to actually raise interest rates. It now thinks it could happen this time next year. If, in fact, the economy is starting to pick up pace and the Fed is likely to raise rates sooner than expected, is that good or bad for stocks?
You know, I think it's good if they're doing the right thing. You know, I don't think the Fed will raise interest rates unless they feel that raising interest rates will not have an impact on the economy. You have to listen to what Chair Yellen says. She wants to encourage the economy. She's going to want to encourage it for some time. Even the first few rate hikes are just a realization that the economy can deal with higher interest rates. It's not a reduction in the stimulus, really.
So, John, are you doing anything differently with your investment strategy given today's news and just the momentum that we've been seeing over the last couple of weeks?
You know, we focused on cyclical stocks for a while, not deep cyclicals. But we focused on things like energy and technology, where earnings beginning to lift off, industrials. I think that's still a good play. And don't forget to look offshore. I mean, I still think that Europe may do better. And emerging markets are in such distress, I would say, that there's got to be a longer-term play there as well.
All right. Thank you so much, John. Have a nice holiday weekend.
Thank you.
John Manley of Wells Fargo Funds.